As a property investor, I've spent the last 14 years absolutely obsessing about the data and how to find Australia's most undervalued suburbs. Now, I've always taken a longer term view of investing, but it is so nice to get short-term gains. And in this video, I'm going to explain 3 different data sets that you can use to accurately find and identify undervalued suburbs in Australia right now. Now, one of the biggest misconceptions around investors is that market moves in this beautiful linear way. And we've all heard the example of a parent buying a house for $500,000 in Sydney 20 years ago, and now that property is worth $2 million, and all of a sudden they've killed it. It's been this beautiful journey. But for investors that understand long-term history versus 10-year data and people that have been in the market for a period of time, property goes through these waves. And if you can pick up properties when they're in the undervalued stage, so the 10-year data is sitting less than the historical long-term average, you can make these short-term upswings that other people miss because they don't understand this stuff. Now, the second data set that I use to find undervalued suburbs with short-term potential to make money is the DSR score. This is the demand to supply ratio score, which can also be found on Google. And there's a paid data set that you can get access to if you want to go to the next level. But effectively, DSR score is looking at a whole bunch of different things in the marketplace and spitting out a number out of 100. Now, as an investor, I can look at a whole bunch of suburbs and look at this one indicator of DSR and get a very, very, very accurate picture of how much demand there is in the market, knowing that demand is the thing that drives short-term prices. So I personally avoid markets with a DSR score below 50. There's not a huge amount of demand in those marketplaces. Generally, prices aren't going to move. They're going to sit flat or potentially decline when I see scores that look like that. Now, me personally, when I'm looking to invest in property, I'm looking to buy properties with the DSR score of about 50 to 70. It means that the market's hot and it's heating up and it's got plenty of pressure in it, but it has not resulted in short-term price growth. When you see the DSR sitting over 75 out of 100, generally that's when auction clearance rates in Sydney and Melbourne are sitting at 80 to 90%. This is when property prices in most areas are going up by at least 10% per annum. And this is a really good indicator. Like when your suburbs turn to a DSR score of this level, you can expect short-term price growth as long as that demand holds. But the sweet spot for buying undervalued properties is looking at that 10-year average, finding suburbs in Brisbane or in Perth that are sitting at between 3 and 5% with a good DSR score. And what I've seen from 10 years of doing this myself is that most likely at some point during the next 5 to 10 years, you should see some pretty significant short to medium term upside growth. Now, during this 18.6 year cycle, we get a period of growth, a small downturn like we've just been through, another period of growth, and then the next GFC. Now, there are 4 very specific times of the cycle to do extremely well out of property, short to medium term, and to find undervalued assets, which I'll explain now. First 2 opportunities once we come out of a GFC would be to target Sydney and Melbourne for the first 7 to 8 years of that cycle. There is an incredibly large amount of data suggesting that the bigger markets around the world and in Australia come out of a GFC much stronger. When I've gone back and looked at 60 years worth of data, I've seen that the average return in Sydney and Melbourne coming out of one of these GFCs is around about 100% in that first 7 years. Then we get to the mid-cycle slowdown point where you can pick up properties for somewhere between about a 10 and a 15% dip. This happened at the start of COVID where property prices in Sydney, Melbourne and Brisbane went down for a period of about 9 months. It wasn't for very long. Where we were able to pick up properties for at least $100,000 below market value. And it wasn't because the broader market dropped. It was because some people were scared and they were forced to sell at that time. Now, once we move through that first part of the cycle where the prices in Sydney and Melbourne, like they are now, are showing an average annual return in the last 10 years of at least 10% per annum, people start going, this is too fucking expensive. I want to start looking for value somewhere else. Now, there's a lot of data to suggest, in fact, looking at the last 60 years of this particular 5 to 7 year stage of the cycle, property prices in Brisbane and Perth historically have again gone up by 100%. We move into the final phase of the cycle where this is the big one. This is where property prices can again come down historically based on the last 60 years of another 10 to 15% in Australia. In America, it can be much worse than this. I've seen property markets in the past decline by 35 to 40%. This is also where stock markets take an absolute bath. Average losses here in the stock market for a period of time are normally between 40 and 60% for a period of 18 months to 2 years. This is the last GFC. You've also heard it called other things like the recession we had to have. You've called it the Great Depression. This is this period where we go through hardship because everything is fully priced at that point. Crypto, stocks, property, commodities, and we go through a reset. This can be an incredibly good buying time if you've got access to capital, but finding access to capital at that time can be hard because the banks can be suffering as well. But there's 4 very distinct stages of the cycle, and this is the way that I plan on trading it. After we come through a GFC, grab Sydney and Melbourne. If I want to, grab some properties for a bit of a dip in the mid-cycle slowdown, grab Brisbane and Perth in the second half of the cycle, and then capture the dip in the next GFC again. But the combination of understanding the 10-year averages, understanding DSR data, understanding longer-term cycles can massively help you as an investor find undervalued suburbs. I'm looking at properties in Australia close to the beach, close to the cities of Brisbane and Perth right now that have 10-year growth rates of literally between 1% and 5% per annum, where their longer-term growth rates in both cities for the last 50 years have been over 9%. I expect off the back of that significant returns in the next 5 years as we ride through this second half of the cycle, and want the absolute best for you so that you can do the same.